You're now listening to episode 85 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi everyone, thanks for tuning in. Thomas Castelli here today with Alina Trigub, former tax accountant and passive real estate investor turned real estate syndicator, who now helps her investors navigate the world of passive real estate investing. Over the last few years, she's helped her investors participate in offerings of over 1,200 apartment units, a $10 million storage fund, and a $10 million mobile home park fund. In today's episode, we discuss the benefits of real estate syndication for passive investors, important factors to consider when doing due diligence on a sponsor, market, and property, plus much more. Hey everyone, I want to let you know that we'll be hosting the first ever Tax and Legal Virtual Summit specifically for real estate investors coming up Saturday, February 29th and Sunday, March 1st. At this event, you'll learn about lucrative tax and asset protection strategies from the top legal and tax experts in the industry. Topics include the real estate professional status, cost segregation studies, 1031 exchanges, self-directed retirement accounts, entity structuring, estate planning, and so much more. Don't miss this incredible event designed to save you thousands in taxes and help protect the assets and wealth you work so hard to build. Head over to www.taxandlegalsummit.com and use promo code RECPA for 50% off your tickets. Again, that's www.taxandlegalsummit.com and use promo code RECPA for 50% off your tickets. See you there. But for now, we're going to jump right into today's episode. Alina, thanks for taking the time to come on the show today. We understand that you used to be a former tax accountant. Could you give our listeners a little bit of information on your background and how you got into real estate syndication?
Absolutely, Thomas, and thank you very much for having me on. So I got my undergrad degree in accounting many years ago, just because I thought it was a good field to be in to get a job, which was very true. I got my first job before I even graduated with a degree, but I never really liked accounting or taxes. So after working in public Big Five at the time and the private world for a while, I realized that I needed to switch the field because I wasn't enjoying being a tax accountant. So I left that field and moved into software development about 18 and 19 years ago or so, and have been in software development ever since.
Nice. And how'd that end up transitioning you into how'd you end up getting to real estate syndication?
Sure. So even though I'm a former tax accountant, taxes have always been on my mind for many years. And especially as my husband and I were growing in our career ladder and getting into higher and higher tax brackets, I kept thinking on how we can minimize taxes. What are the ways? What can we do as two W-2 professionals to change that? And real estate kept coming up, and I like real estate as a field. So finally, about 7 years ago, I started reading about real estate and digging deeper to find out what are actually the ways that one can invest. And at that time, I also started looking for properties locally where I live, which is in New Jersey, but the numbers would never make sense. It's been always, the numbers are very high, and I could not find properties where it would make sense, where it would have some returns. So I decided to start looking out of state, and I started reading about out of state investing and came across the world of syndications. I decided to read up more on it and do some research. And after doing the additional research, I thought it was a viable option. And I took action and found a few operators on BiggerPockets, reached out, found some deals, and then after evaluating, invested in one and then another and kind of escalated after that. So I started out essentially as an equity partner in someone else's syndications. And after doing that for a few years and realizing all the benefits, not only the residual income, but on top of it, you're getting the tax benefit. Granted, you're a passive investor, but as a passive investor, you get the benefits of depreciation, and you're getting passive losses, especially at the beginning, that when they're higher. And on top of it, they could include the cost segregations with accelerated depreciation. So it was just tremendous. So those two huge benefits made me realize that this is something that I need to bring up the market, because none of my surrounding, at least friends, family, people I know, ever heard of syndication. So I started my company with that sole purpose of educating people and helping them get acclimated and start passively investing in real estate. Because a lot of folks are interested in real estate, but very few want to actually buy a property, place tenant, and be responsible for those phone calls at nights and having to fix someone's issues. Where the syndication allows you to become investor with very little to no involvement. You just essentially review the document and then make your decision and invest, and that's it. So essentially, you're doing it with limited interruption to your day-to-day life, whatever you're doing, which is a huge benefit and a huge opportunity for folks that are very busy with their personal life, businesses, adventures, professional life, family, and so forth.
Yeah, absolutely. That's the blessing of syndication. So when you're involved in the syndication now, you've transitioned from just being a passive investor to now taking a more active role. Right. What role do you typically play in the syndication process?
Sure. So my role involves multiple things, which include from being the investor liaison, helping investors get acclimated, educate them on the process, helping them to decide to partner up with us, essentially explaining how syndications work, to doing due diligence on the asset, on operators, and on overall process and the market to decide whether a specific market and a particular investment is a viable option for myself and my investors, and whether we're going in to work on it. And then once we're in, it's essentially playing a full role of being the investor liaison, explaining investors how the investment is going, providing them updates, helping them if they have self-directed accounts, helping them with their administrative stuff, and being their connection to the investment overall.
Got it. A lot of investor relations in there. It's always exciting stuff.
Yeah.
So when you so you mentioned that you basically help your investors get acclimated and do the due diligence on the operators. What type of due diligence, like as a passive investor, what are the most important aspects of a deal to do? Like, I guess, what are the most important due diligence aspects that a passive investor has to be concerned with?
Absolutely. So I would say there are three important things that investors need to be concerned with. Number one is the operator, number two is the market, and number three is the deal itself. And I always suggest to passive investors to start with the operator, because operator is everything. If you have a good operator, let's say you have a good operator but bad asset, you are still in a better place as opposed to having a bad operator but good asset, because a bad operator can turn good asset into a bad one, but a good operator will take care of that bad asset and will make sure to turn it into a good asset. So always start your due diligence by speaking with the operator, asking them questions that are important to you as a person and that are important to you as someone approaching a business owner. So syndications and buying investments is a business. So ask them questions that are relevant to their business model. How long have they been in business? How long have they been doing this? Are they concentrating on one particular asset class or multiple? How many markets are they in? And then look at the geography. Are these markets more or less nearby? Are they overlapping? Or are these markets all over the place? Say, one is on East Coast, one is on West Coast. That may not be the best option. I mean, in some cases, they do have teams and boots on the grounds. But in general, if their markets are co-located or close to each other, that tells you that operator is looking to grow or is growing in a specific area, building their team, and have some of the resources overlap so they can go into these multiple mini markets that are close to each other. Ask them about their strategy. Have they been implementing the same strategy, similar strategy on multiple assets, or does it differ from asset to asset? What's the approach to the type of asset they're going in, the type of areas they're going in, and then based on the answers, just make a decision for yourself. Does the strategy that this operator is implementing, does it align with my values, my beliefs, and my interest as a passive investor? Is that in line with my expectations? Ask them the typical turnaround of a deal, what are their plans, whether they typically have multiple exit strategies or a single one. And then based on those answers, because you have to realize there's no black and white. There could be red flags, whatever they say could be a red flag to you or to everyone else. But essentially it's aligning your interests and beliefs and goals with the interests and goals of that operator. And if those two align, then this potentially might be an operator whose deal you want to consider.
Absolutely. In my experience, I've made a handful of investments with different syndicators in the past. I've syndicated a property, and I've worked with a lot of syndicators here at the firm. Mm-hmm. And just from your experience, you had mentioned that one of the questions you need to ask the sponsor is or the syndicator or the operator rather is is to ask what markets are they in and look at, are they in markets that are close by to each other, look at what type of asset classes they're in. From your experience, have you noticed that say better returns or a better working relationship with a syndicator that is more has their operations more geographically based, like say within the same few cities? And also at the same time, have you seen better returns for those syndicators that focus only on one strategy rather than say doing multifamily, self-storage, mobile home parks, a mix of different things?
Sure. And the answer is it depends. The mm-hmm. typical tax accountant or accountant answer. It depends. It varies, and I'll tell you why. In terms of the markets, for instance, in terms of the geography, if it's an operator that has taken, let's say, one particular market in their hands and had worked in the market for several years, has established team, has established relationship with brokers, attorneys, insurance agents, general contractors, and so forth, and has the well-oiled machine in that business, the business is already running, they've purchased multiple properties, and they basically doing what Bigger Pockets calls BRR strategy, where buy, refinance, repeat. They buy a property, reposition it, refinance it, and continue to the next one. If that machine is working, and they're now looking to go to, let's say they're in Houston, Texas, and now they're looking at Tampa, Florida. While those markets are not co-located, but if one market already has the well-oiled machines and the assets are operating more or less on its own, and they're just spending a couple of hours on observing what's going on, and there are multiple partners where one partner may still be heavily concentrating on asset management and repositioning the property, but while another partner is doing the deal sourcing and looking at, let's say, Tampa, I think it's okay, it's fine, because both strategies are taken care of by the partnership. There are multiple partners, each has their own role, and they're fully functioning in those roles. But if, let's say, it's a one-man show, and they're looking in Tampa, in Houston, in Phoenix, Arizona, being all over the place, and just because someone is sending them a deal where the numbers look good, you're not going to get far with this strategy. You have to concentrate on one thing, and I can't stress enough that concentration. And for those that have a hard time concentrating on one thing, I highly recommend reading Gary Keller, One Thing. The book is outstanding. It helps you get focused. It helps you put your mind on more important tasks while giving the less important tasks to other people on your team, so that the work that you're putting in pays off at the end. So very, very critical.
Got it. Great book, and I still have not had a chance to read, but I heard very good things about it. So just kind of
put it on your list.
It's going to be on my list. It's going to be up there very, very soon. when it comes to, kind of circling back to some of the things you had said there, it kind of sounds like what's important is you're looking for that well-oiled machine. You want to see a syndicator that has a well-oiled machine. And if they're going to be in multiple markets, you want to look at the team. Do they have a big enough team to support that? And can they replicate what they maybe did successfully in one market in another one?
So are they ready to scale? They're taking what's working in this market and placing it into another market to build up a similar machine.
Yeah, exactly. I think that's why it's kind of hard to give a black and white answer to it, because you really have to look at the operations of the sponsor and say, how are they currently operating? If they're going to expand into a new market, you have to have trust that they're going to be able to duplicate that efforts, and they have enough staff or enough partners to make sure that they are covering both sides, I guess you could say.
Absolutely.
So when you're looking at, after you do the due diligence on the sponsor, as a past investor, would you just stop there, or are you also going to look at the market as well, do some market due diligence?
Absolutely, I would look at the market as well. What market are they operating in? Does that market make sense? And again, I'm talking from a personal perspective, but typically things that I look for in the market is the market well established. If it's a smaller town, are there major highways in the area? Is there access to the big city? Is there infrastructure in the area? If I need to access the market, how easy it is? A direct flight, or do I have to take multiple flights? To me, that's an obstacle. I don't want to be taking multiple flights. I want to have direct. Is the population growing? Are there jobs coming into the area? Will the job market support that population growth? And what's also important, are the jobs that are coming into the areas and those major employers, are they the ones that are going to be staying there, or are they going to be replaced by the next Amazon tomorrow? I want to make sure that they have larger hospitals, big colleges, places that can support the economy, and places that are there to stay for a very long term. A lot of people, or some people, like to go into military towns, and while it may work for some demographics, I'm personally trying to stay away from the towns that are purely military and don't have any other prevailing industry, simply because militaries, again, they come and go. They could be relocated to another place at some point. So that's one of the things that I would consider only in conjunction with other industries. So those are the typical things that I look at when evaluating the market.
Got it. It's kind of, you kind of said the same thing along the lines that my mentor always says, and it's jobs. You're looking at the markets. Where are the jobs going? Are the jobs permanent? Is there just diversification in the job market?
Yep.
And really, the job market's what's going to drive population. So you would definitely want to make sure that they are jobs that will be in place for an extended period of time and just won't go away, because that could make or break your deal.
Absolutely.
Now, when it comes to the individual, so I guess after you do the due diligence on the sponsor and you say, I'm ready to move forward with the sponsor, you look at the market, you say, I'm comfortable with the market. What type of due diligence do you do on the individual property at that point?
Sure. And by the way, in terms of the diligence on the operator, it's not only about that questionnaire, Q&A. It's also asking for references, speaking with prior passive investors, if possible, if those investors allow that, checking their background, checking their resume, track record, and so forth. So it's a lot more involved than just giving you stuff on the high level.
Absolutely.
Now, going back to your question about the deal itself. So when it comes to the deal itself, again, some people may say, oh, it has 10% cash on cash and, 18 IRR, perfect, I'm going. You can't look at the numbers in silos. You have to look at the picture overall. So when it comes to the numbers, same thing. You have to look at all of the numbers together. 18% IRR can mean multiple things. It can mean that you're getting cash at the beginning, or it can mean you can get a significant chunk at the end, or it does not tell you the full story. So always look at the picture overall. Cash on cash, average annual return, equity multiple, look at the whole time, look at the underwriting that's there in a offering memorandum, how that's done. Look at what type of vacancy are the operators projecting? Are they saying that, let's say, what one of the red flags that would be a red flag for me, for instance, if they're saying that the vacancy will remain at 5 to 10% and we need to do significant repositioning. If you're buying, let's say, $100 property and you want to do significant repositioning, your vacancy will absolutely not remain at 5 to 10%, at least for the first 2 years. It should be, in my estimation, 15% or maybe higher, at least first year around. Maybe second year you can do better. But you have to be realistic. If you're putting a lot more emphasis on the first year to do that heavy repositioning, then again, that vacancy should be higher, and you should have enough cushion in your reserves to cover for any unforeseen circumstances. Also look at the expenses, of how the expenses are progressing, how the rents are progressing. Are the operators saying that we're going to be increasing rents by 5 to 10%? Again, if the area is supportive of that, the geographic area, then maybe again. But if the area is not, if you need to lower the numbers, if everyone else is increasing rents by 2 to 3%, then there's no way you're going to be going to 5 or even 10%. So look at things like that. Also, look at the strategy overall. What is operator projecting they're going to be doing? Are they going to be changing units completely, or are they just going to be replacing, doing some touch-ups, maybe some paint, and maybe changing the doors and windows, or are they changing the kitchens, bathrooms, and so forth? Are they also maybe replacing roofs or building a kids' playground or something else? So look at those things. Come up with an estimate as to how much do you think those things may cost, or maybe ask a local contractor and see if in a ballpark the number that they have in their offering memorandum agrees with what you have. Again, the number may be different, but the ballpark should be, if in your estimation it should cost 60 to 80,000, but they only allocating for the renovations, let's say 20 to 30 grand, then obviously there is some disconnect, and that doesn't mean it's a red flag, but it's something to ask the operator about. So look for things like that. Read what the strategy is overall, how long are they planning to hold the property, how many exit strategies that they have, what other options they have, what kind of loan are they getting, is there an interest-only component in the loan, are they getting a bridge loan, or is it just a long-term, is it recourse and non-recourse? How long the partners have been in business, have they always used the same bank, or are they using different bank, and so forth. So just read on a document and come up with a list of questions, and then go over your questions with an operator, unless those questions are already answered through the webinar that most of operators are doing these days, and typically trying to cover the majority of the Q&A. And in general, the more reviews like this you do, the easier it will become down the road. It may be harder at the beginning, especially if you're not familiar with the financial terminology. But as you get more and more into syndication, start investing and looking at 10, 15, 20 offering memorandums, it does get easier, and you start spending less and less time on it because you understand how to read these documents overall.
Got it. So you have to. There's a lot that goes into evaluating the property. I mean, at the end of the day, I would say for listeners out there, definitely the sponsor is definitely the most important part. So I definitely agree with that there. If you're investing with a good sponsor, they're going to already pick out the market, or they should already have a good market in place. They should already be picking out the property and doing a lot of things that Alina had just mentioned. But if you're going it alone, if it's your first time, you definitely want to seek advice from mentors or coaches or people like Alina who's done this before, people who are experienced in picking out these properties and have success. So Alina, I know you do. What would you say your best 2 to 3 tips are for people out there who may be listening to this, who may already have been a passive investor and now looking to perhaps raise capital for these types of syndications? Do you have 2 or 3 tips that you could throw out there for those listeners?
I would say grow your brand, and also work on a relationship. Real estate is a relationship business. So if you start building relationship early on, before you even have any deals to invest in, and just talk to people, explain what you do, how you do it, show your track record, show the record of the people you're partnering up with, and be patient with it. Then the network will follow you, and you also need to be bringing value to other people. So if investors are reaching out to you with questions, you should be able to answer those questions. If you're not in a position to answer the questions, if you don't know the answers, then I would say spend more time on educating yourself, understanding how the process works, understanding how understanding the investment life cycle, and continue picking up the pieces of investing, syndications, and until you have a full grasp. And it's okay to tell investors, I don't have the answer for you, I'll have to get back to you once or twice, but you need to be able to explain majority of the things in the syndication business and know how it works. So it's a people business, so establish and build relationship with other people. And the first thing that should come out of your mouth is typically, how can I help you? Because you're there to help these passive investors. You want to help them build their wealth. You're not there to take their money. You're there to help them multiply their money and make more so they can build the wealth passively while concentrating on other things that are more important to them. So make an emphasis on that.
Got it. Thank you. Thank you for sharing that. When it comes to other forms of passive investing, have you ever explored any other forms of passive investing? And if you did, are you involved with any currently?
Sure. So outside of real estate, I've looked at other asset classes that also offer passive investing. Things like, for instance, oil and gas, hemp investment, then assisted living. I have invested personally in assisted living, and while there is some real estate component, excuse me, a huge piece of it is the operations. It's a big business, so I consider it an alternative, and it helps to diversify portfolio. And I always encourage other people to look into diversifying their portfolio so they have a balanced portfolio at the end of the day.
Awesome. That's great advice. So, given your tax background and also you're in real estate syndication, what are some tax strategies that you use to minimize taxes?
Sure. The most common strategy we implement is buying value add assets and repositioning them. That brings the depreciation effect, especially in the beginning few years, and allows us to have passive losses at the beginning versus passive income. In a lot of cases, especially when properties are older, we typically employ the help of cost segregation experts.
Yep.
And we, which allows to use the benefits of accelerated depreciation as well. And aside for that, I personally haven't invested in opportunity zones because I was looking for the laws to be finalized. I know they have been recently finalized. I think it's a viable strategy, especially for someone who looks to defer significant gains. I think it's definitely an opportunity, and I would strongly encourage people to look into that.
Absolutely. Opportunity zone is a big opportunity, no pun intended, that's going on right now. It took a little while for the IRS. It took a little longer than a little while. It took them about 2 years or so to finalize those regulations, made it tough on people to move forward. But there is certainly opportunity there for tax savings. When you talked about the cost segregation studies, which is a lot of syndications do cost segregation studies and pass through the passive losses to their investors. And there's oftentimes, I get these type of questions from our syndication clients all the time. And they ask, my investors asking me, they're a doctor, dentist, lawyer, whatever the case is, can they use the passive losses to offset their W-2 income? Do you get that question a lot too?
Yeah, I do. And it takes a while to explain to people that, you can only offset your passive income against passive losses, not your W-2 income.
Yeah, and that's why we have the real estate professional status for some folks, and we're not going to go into that too much today. We've beat that to death in other episodes, but
sure.
Just wanted to let everybody know out there you're listening. If you are a full-time W-2 employee or you run a full-time business outside of real estate, and you invest in a syndication, you will not be able to use the passive losses against your ordinary income, at least while you're in the deal. There's an opportunity when the deal liquidates that those passive losses will be unlocked, but that's not until the very end. So if
unless you have a spouse who is either not working or working part-time and can potentially show that they have been engaged in real estate 750 hours, whether they're agent or another capacity, and they have been actively managing your properties. In that case, you might be eligible to claim a real estate professional status.
Yeah, absolutely. That's spot on. That's spot on. And the key there is the active participation in a rental portfolio. So it's commonly what we'll see, to your point, Alina, we'll see perhaps a couple who one of them is working full time, the other one starts building a rental portfolio. And then what we can do is, depending on some specifics, some technical details, which we won't go into, but there is a possibility of being able to group together your passive investments together with your active investments to mitigate those taxes, which is exciting, but it's complicated.
Exactly.
We always ask everybody this question, and it's, what is your favorite technology or software you're currently using in your business?
Favorite technology? I think Gmail. It helps me connect faster to my audience. I guess, as rudimentary as it sounds, I like Gmail the most. It has failed me much fewer times than any other software that I'm using. But obviously I'm using a lot more. There's CRM system, there's project management system, there's instant messaging. I mean, too many systems to list. But I guess email.
We love Gmail. We love G Suite over here too. So never fault someone for loving Gmail.
Yep.
What is the best way for our listeners to get in touch with you or learn more about what you have going on?
Sure. They can find me on social media. They can type my name, alinatrigub.com, or they can type my company name, samofinancial.com, or find me on LinkedIn, BiggerPockets, Facebook, or Instagram.
And for everybody out here who's from New York, who's listening from New York, I think you do have a
meetup. Yes, I forgot to mention. I have two meetups. One is locally to me in northern New Jersey. The other one is in the city. So for anyone who is in tri-state area and would like to join our meetups, we're on New York meetups quarterly and New Jersey meetups monthly. So welcome to join us.
Awesome. Well, thanks so much for taking the time to come on the show today and walking our listeners through how, what aspects of due diligence they need to be doing when making a passive investment syndication. I'm looking forward to releasing it.
Thank you.
Hi, everybody. It's Thomas Costelli here today for the debrief portion of today's podcast. I'm going to keep this one short and sweet. As Alina and I discussed on today's episode, evaluating the sponsor is arguably the most important part of the due diligence process before making a decision to invest in a passive investment opportunity. Their track record is key. You want to be sure they have a consistent track record of delivering strong returns with the property type and the investment strategy they are offering. While market and property level due diligence are still important, if you choose the right sponsor, and the sponsor is the operator, generally speaking, they will have already done most of the heavy lifting for you, and now you're just verifying. In the end, it's the sponsor who's going to be operating the property and who's going to be responsible for your hard-earned capital and providing you a return on your investment. A good sponsor could turn a bad situation around. Meanwhile, you could have a solid property in a great market, and a bad sponsor could just tear it all down. Like famous investor Warren Buffett says, it's got to be a management that I like, trust, and admire. We all know that Warren Buffett puts a big emphasis on the management team whenever he makes an investment. And really, while you're investing in real estate syndication, it should be no different. Management is key. And today we have a question from Amy. And Amy asks, if I'm overseeing the construction of my primary residence, will those hours count towards the real estate professional status? And the answer to that question is generally no. In order for hours to count towards the real estate professional status, they must be worked in a real property trader business. And while construction is certainly a real property trader business, unless you are in the business of constructing, then those hours won't count. Now, if you are in the construction business, there may be some tax planning opportunities where you can qualify those hours that you're spending overseeing the construction of your primary residence. It'll probably come down to the timing of the purchase and exactly how the transactions occur, but there may be some opportunities in there, so you'll want to speak to your tax advisors to see if that situation is something that applies to you. And remember, folks, if you want to have your question answered here on the Real Estate CPA podcast, head over to www.therealestatecpa.com/podcast. Drop your question in the box found on that page, and we may just answer it here on the podcast. Thank you for tuning in. Thomas Castelli signing out, and we'll catch you next week.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.